Hello, I'm Jason Kelly. Thanks for joining me. In this video, I'll look at the rise of Amazon.com over the last 20 years and how its success has defied valuation measures and gives a warning to everybody hoping to use them to success in the stock market. Amazon.com went public on the NASDAQ in May 1997 at a value of $438 million. Today, it's worth more than $460 billion. Look at this chart from Recode showing the price of Amazon stock up 600-fold over 20 years. Look at that line. I remember the days back around 2000, that first blip on the chart. It didn't look like a blip back then. It looked like a rising mountain range as Amazon went up to $100 a share, and everybody was saying, $100 a share? This thing's going to come crashing back down to earth. And indeed it did after the dot-com peak and then the ensuing bubble pop. And then it went along, it looks like sideways on this chart, but that's simply because after the subprime mortgage crash, Amazon went to the moon. You can see it getting up there, closing in on $1,000 a share with just an absolute ascent at the end. And the entire way, people saying it was overvalued. Well, it's more overvalued than ever now. 2 years ago, its value surpassed that of Walmart's. Look at this, another chart from Recode. Amazon became more valuable than Walmart in 2015. Look at that red line shooting across the Walmart gray line. How's Amazon done it? It's kept revenue climbing. It has always emphasized revenue, and it has reinvested every single dollar in sales into its businesses, expanding its businesses, using the ones that are creating a lot of operating cash flow to subsidize the ones that aren't. And it's the way it's run circles around traditional retailers by supporting its low prices with other higher margin parts of its many different business divisions it has going. Look at another chart from Recode. This shows Amazon quarterly revenue versus its net income. Look at that. Net income is the dark red horizontal line at the bottom of the chart, right along zero. Basically no net income over this 2-decade span. But look at that rising revenue line. All those peaks along the way, the jumps and then settles back, those are fourth quarter results. Just like other retailers, Amazon does most of its business in the fourth quarter for the holiday season. And so the series of cones on the rising line on the right, those are fourth quarters along the way, and the other quarters are 1, 2, and 3 for the different years. It now commands a 33% share of the United States e-commerce market, which is just astounding. And it got started, of course, when that market was young. It has kept doing better and better at what it does, and it's gone into other areas to, as I mentioned earlier, support its retail operations in e-commerce. Now, it is an unequivocal success. It's just, we can't argue that now, right? Looking at these results, bigger than Walmart, sales going up, getting better all the time. The question is, as an investor looking back, did you buy it? Probably not. Even if you did you buy enough of it? Did you short it? Did you participate in Amazon at all? If you didn't, don't feel bad, because you and everybody else was told all along the way that it is overvalued. Overvalued. That's what we were told all along. Its price to earnings ratio doesn't make sense. And it really didn't make sense, to be fair to these analysts who were saying that. Look, a typical stock, if there is such a thing, the stock market itself, the S&P 500, has a historical PE ratio, the price to earnings ratio, of about 14 to 18, depending on the source you look at, 14 to 18. Walmart's PE ratio right now is 17. Microsoft's is 30. And there was a time when people thought 30 was nosebleed. 20 was getting to be overvalued. 30 was getting to be nosebleed territory. And yet, Amazon's current PE is 180. What do we do with that? 180 on a chart that enters nosebleed territory traditionally at around 30? And that's not even the worst of it. Look at this. It's been a lot higher than that. Look at this chart from Zacks. This goes back a few years, back to 2013. Unfortunately, both lines on the chart are green, but the one that rises to a higher level on the right is the price line, and its scale is over there on the left. And then the other line that ends over at 180 on the right, that's the PE ratio over time. Now look back into 2013. That PE ratio was up over 2,000. Up over 2,000. Again, What are investors supposed to do with a valuation measure that normally starts being talked about as nosebleed, way too high, watch out, short this stock at about 30, 35, 40, 50? Come on. That's when the old timers start shaking their heads. A PE of 50? Enjoy the ride, suckers, at about 50. And Amazon was over 2,000. It looked like an accounting error. It looked absurd. But one of the most successful stocks of the last 2 decades. The reason we look at this is not to feel bad for not having owned it or to feel bad for having shorted it or anything like that. The main takeaway today is not profit financially, it's profit through wisdom. Let's understand that these stock measurements don't mean a thing on their own. They really don't. There is nothing you can hang your hat on as being reliable with stock analysis. Those valuation measures that said Amazon was too expensive and you shouldn't own it were correct in many other cases, but they steered you away from what was one of the very best investments of our lifetime. Keep that in mind. Keep that in mind. When you see somebody warning you away from something because it's too expensive historically, or towards something because it's a bargain historically, just remember, prices can go wherever they want to go, wherever investors want to drive them for whatever reason. At the end of the trading session, the time period, your lifetime, the market is a social system, not a mathematical system. And what looks good on paper, what looks great in a chart, what makes for fantastic PhD level analysis doesn't mean a thing when the animal spirits are let loose and people take prices wherever they want to go. That's the takeaway from the Amazon story, because it's too late to buy it 20 years ago, and who knows what will happen from here. Just remember, it was way too expensive all along the way to a fantastic profit for those who bought it. I hope this gives you some perspective and you can get some wisdom from Amazon, if not direct financial profit. Thanks for watching. If you're a Kelly Letter subscriber, I will see you Sunday with fresh material. And if you're not a subscriber, please subscribe. JasonKelly.com.